So this is going to be a technical trading framework that's going to help you handle the markets with probably greater confidence and a bit more consistency. So let's break down the core components of this strategy. Now, at the heart of this approach are two key exponential moving averages, the 3-period EMA and the 10-period EMA. And we have one simple moving average, the 20-period. Now, each of these serves a purpose, a specific purpose in our trading framework. So the 3-period EMA is the fastest, it's the most responsive to the price changes. So it's like our short-term, very short-term trend indicator. It's going to quickly identify the current market direction. The 10-period, a slightly longer-term perspective, a bit more reliable gauge of the underlying trend. And the 20-period SMA, well, this is going to be our overall trend confirmation tool. It's going to help us filter out some trades. It's going to ensure that we're trading in alignment with a bit of a more of a broader market momentum. And we're using the SMA intentionally because we wanted to have a bit slower response time. So let's get into the specific signal generation. So a buy signal is generated when the 3-period EMA crosses above the 10-period EMA and price is also above the 20-period. On the flip side of that, a sell signal is triggered when the 3-period crosses below the 10-period and the price is below the 20-period. So for example, this is a hypothetical trade. It's a 15-minute chart. When the 3 EMA crosses above the 10, price is above the 20, we want to enter a long position. We're going to place our stop loss order just below the most recent swing low because if that breaks, the pattern of higher highs and higher lows is broken. Now, this buy signal confirms the market is in an uptrend, provides us with a bit of a more of a higher probability opportunity to capitalize on momentum. And the beauty of this is how versatile it is. It can be used across multiple time frames that's going to suit your own trading style and your trading goals. So if you're a short-term trader and you're focused on day trading, think of the 5-minute to the 30-minute chart. It's going to allow you to capture the intraday price swings, which generally on the lower time frames are a bit smaller. If you're a swing trader, you might like the 1 hour or the 4 hour, where the strategy can identify medium-term trends and potentially larger price swings. But regardless of your preferred time frame, the key is to select the one that aligns best with your risk tolerance, that aligns with your available trading time and your overall trading objectives. Now, effective risk management is the cornerstone of any successful trading strategy. And this one here, it's no exception. Here's the core principles we're going to be implementing. We're not going to risk more than 1 to 5% of our trading capital on a single trade. So this is going to help us preserve our account balance and avoid account killing losses, even in the string of unfavorable market conditions. But I will say this, there are times, depending on my own personal setup, my own trading, that I'll risk upwards of 10% on my account, but the instrument is showing a higher chance of a strong movement in my direction. It's usually volume based. Our stop loss below the most recent swing low for longs, above the most recent swing high for short trades. And of course, you want to adjust around any obvious structures. Now, this approach is going to ensure that we are protecting our downside, but we're still allowing this trade to breathe and potentially reach our profit targets. And of course, you can use other methods, such as the ATR for your stops. Okay, but this is a framework. You have to fill in the details that suit you. Our take profit targets, we're going to aim for a minimum 1-to-1 risk-reward ratio. And I know that flies in the face of everything out there. And all this means is our take profits are going to be at least the distance of our stop loss, because this helps us capture gains. It's going to help limit our losses. And hitting 1-to-1 is a highly likely scenario, regardless of how you're trading. And to further improve the reliability, let's incorporate additional tools to confirm the strength of the move. Number 1, don't trade the cross. No, really, look for the pause after the cross. We want to see some sort of consolidation. Trade the breaks of that. Second, we can look for candlestick patterns, bullish or bearish candlestick patterns, engulfing patterns, pin bars. That's just going to help validate the direction of the trend. It's going to increase our confidence in the trade setup. at that time, right? Things change. But ensure that these are happening 1 to 5 candles after the crossover. If not, skip the trade. Momentum indicators like the RSI and the MACD, these can provide some insight into the underlying strength of the market, help us identify overbought or oversold conditions. And when you combine the crossover signal with these confirmation type tools, you're going to filter out some failed trades, and you're going to ensure you're entering the trade with, at least at that moment, has a higher probability of going in your favor. Things change. The next candle can go against you, but we never know that. And of course, no trading strategy is complete without you taking the time to backtest and optimize it. It's going to help you identify the most effective EMA periods, the most effective risk management for you, for your trading style and your market environment. Don't go down this rabbit hole of looking for the perfect settings, right? Look to use price action and volume as your main driver of a trade. So the takeaways here, the big ones: start to paper trade the strategy on a 15-minute chart. Use the 3, 10, and the 20 as your primary signals. And then incorporate other tools like the patterns and momentum indicators to validate your trading signal. But before you add any other tool, use the consolidation method after the cross as the first thing that you're going to test out. Now remember, your results are going to be different than my results or the person next to you, right? So just because they're succeeding one way, it doesn't mean you're going to, because let's be honest, nobody out there is going to follow anyone else's trading plan to the letter. It just doesn't happen. I want you to experiment with different time frames. You got to find one that suits you, your trading style, your goals, and even the instrument that you're trading. Some instruments do better on short term, some instruments do better on long term frames. Backtest your strategy. You got to optimize the parameters to achieve the highest possible performance, but at the same time, be aware of over optimizing, because that's going to produce a strategy for you that is not robust. Start with small position sizes. Gradually increase your risk as you build your confidence and build consistency in your trading. And one of the biggest ones, document your trades, analyze your performance, and make adjustments. Start up a trade book where you screen capture all of your trades, the winners, the losers, where you screen capture all of your back tests so you have a book that you can look at what succeeded and what didn't. Remember, any strategy can work if they follow the inherent structure of the market. That's why when we look for the crossover, that's the momentum. Then we look for consolidation, that's the pause. And then volume on that break, that consolidation, over time, that's going to do a heck of a lot better than just trading the cross. But all of this requires practice, discipline, and a commitment to always improve. Let me know in the comments how you're approaching this. Talk to you soon.
Everything discussed here is our opinion, and it is not to be taken as investment advice, because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.